So if you own a business or you're self-employed, should you incorporate for the tax benefits? So when it comes to incorporating, there are a lot of benefits, advantages, but there's also some downsides and some disadvantages. And whether or not it makes sense to incorporate just depends on many different factors, like your business situation, if you have multiple partners or not, the revenue you're generating, the industry you're in, the amount of liability protection you want, and things like that. So I would almost never say approach incorporating just from one perspective, because you have to look at all those different things. But in some cases, maybe that's what's going to put you over the top and force you to make that decision to incorporate, is the tax benefits and the additional tax strategy that you get with having a corporation. So for example, if you are doing something like consulting or web design or something like that, where you've created a business, but it's more so just like a career for yourself, and you want some extra tax strategy because you're starting to generate more money than you actually need to live off of, and therefore you're just paying more taxes than you need to or would like to. In cases like that, it can make sense to incorporate. However, keep in mind that with incorporating, it is more money to set up, it is more money to maintain, it is more work to set up, and it is more work to maintain. So you have to consider the trade-offs. Is it worth it? Incorporating can be quite expensive, especially if you're hiring a lawyer to help you do it. That can be $1,500 to $3,000, kind of depending on the jurisdiction you're in, the nature of the incorporation, and how complicated that process is going to be for your situation. And then just administratively, it's more work because it's a separate entity that has a separate tax return, it has a separate bank account, it has separate sales tax accounts. There's a little bit more paperwork involved with having a corporation. So it's not to say don't do it, but you need to consider the advantages and disadvantages in order to determine if it makes sense. So in some cases, when it just comes to tax strategy, it might make sense to incorporate, again, depending on your situation. However, I wanted to just say that before you jump into incorporating for tax strategies, I think there are some alternative methods that can be really valuable, that are easier to do instead of incorporating, or at least can delay the time in which you decide to incorporate. So in Canada, we have some registered government savings accounts and investment accounts that are really valuable tax instruments or tax tools or tax accounts, whatever you want to call them. And those are the RRSP, the Registered Retirement Savings Plan, the TFSA, which is the Tax-Free Savings Plan, and then the FHSA, which is the First Home Savings Account. So these three accounts are really valuable for tax strategy, and they can all be utilized for any individual, business owner, self-employed, or even for an employee. But in the case of a business owner or a self-employed individual, these can be better than incorporating in some cases, especially if you're eligible for them. So the first account is the First Home Savings Account, which is a savings account to purchase your first home in Canada. And this can be really valuable because anytime you put money into this account, it reduces your taxable income. So for example, if your net income from business for the year was $60,000, but you moved $10,000 into that first home savings account, now your net income that's taxable is only $50,000. So you removed $10,000 from your taxable income, so the amount of tax that you're gonna have to pay has diminished significantly just by transferring money into that account. And now when you take that money out of the account, as long as you use it to purchase an eligible first home, you don't have to pay tax on it pulling it out. So this can be a huge tax benefit. Now the RRSP account, that works very similarly, where it's like a tax shelter, for tax deferral, and it's more designed for retirement. But there is also the RRSP homebuyer plan, which works similarly to the First Home Savings Account, where when you put that money in initially, it reduces your taxable income. And then when you take it out, as long as you take it out for an eligible home purchase, you don't have to pay tax on it either. Now, another thing with the RRSP, it's kind of misleading because it makes it sound like it's just for retirement. But if you're ever planning on taking some time off, like a sabbatical year or, kind of like a parental break from work, then you can take money out of your RRSP account in those years where you're working less or not working at all. And yes, it'll still be subject to income tax. But if your net business income is really low that year, you'll pay less tax on it and be in a lower tax bracket. So that can be used as a major tax strategy or tax tool as well. And now the TFSA, this one is a little bit less useful because with TFSAs, you're putting in after-tax money. So that's money that you've already paid income tax on. Still a very useful tax vehicle where you can earn capital gains from investments and not have to pay taxes on that investment gain. But it's not really going to reduce your taxes in terms of income taxes from money earned. It's just going to reduce your taxes on investment income. made from investments that are in the account. But so anyways, just to summarize, I would say before choosing to incorporate, especially if the tax strategy is the main thing driving you to incorporate, just make sure that you consider these registered tax shelters and tax savings programs, because these alone might be more beneficial than incorporating in some cases. So hopefully this video was useful. If so, please click like and feel free to subscribe to my YouTube channel here, where I currently have over 265 videos that cover business startup and business management topics.